No, wait a minute.
Okay.
Jesus.
All right. Looks like we're going. All righty. Okay. If you guys are not on mute, if you could mute yourselves. If not, I'll help do that. Okay. All right, we'll get started. Good afternoon, everyone, and welcome to the third seminar of the Jewish Federation's Professional Advisory Council, or the PAC as we call it, the 2021 year. So this one is all assets are not created equal. Other than cash, what can I use to make charitable gifts? My name is Shannon Small, and I am the Financial Resource Philanthropic Officer for the Jewish Federation of Nashville. I will be facilitating and moderating today's seminar. So our PAC, as most of you know, is a group of attorneys, accountants, financial planners, insurance brokers, and wealth advisors that provide education to the Jewish community related to wealth transfers to families and for charity. The Jewish Federation, along with our 11 partner organizations, have asked their supporters, including many of you here today, to sign letters of intent indicating you're planning on leaving an after-lifetime legacy gift, which will leave a long-lasting impact in the Nashville Jewish community for future generations. More than 767 letters of intent have been signed. This is over $21 million have been left in gifts to the Nashville Jewish community, and over 67% of those letters of intent have been formalized. And the Life and Legacy program sponsored by the Jewish Federation in partnership with the Harold Grinspoon Foundation, and we appreciate all your support. Obviously, as I've done before, I'll be emailing out information from the presentations today. If you have a question, if you haven't been here before, the time for questions will be after the presentation. You can use the chat feature. You can private chat a question to me if you'd like to stay anonymous, or you can put a chat question for everyone to see. I will be moderating the Q&A. Also, if you'd rather verbally ask your question, you'll have an opportunity to do that. Again, that'll be the second half. So today we'll hear two short presentations for the first 40 minutes of our program, and then we'll have a Q&A again for the second half. We will get started. Our first presenter is Mindy Hurt. She is a wealth advisor and senior vice president of Argent Trust. And as a wealth advisor, she serves select high net worth families with trust, investment, foundation, estate, and family office services. Her main focus is multi-generational family governance and dynamics. She'll be doing an overview of the giving vehicles today. Our second presenter is Mike Levine. He's been in financial service business since 1987 and is a top of the table member of the $1 Million Roundtable. He's been a featured speaker at many professional and business seminars, and his specialty is retirement income planning. And he'll be going over more of the insurance side today, along with a few other tips. So we'll get started. I'll have Mindy, I'll have you get started.
All right, let me see if I can share my screen. And can everyone see that, Shannon?
Yeah, I can see it. Yeah, it looks good.
All right. So as Shannon said, I'll be going over charitable giving vehicles.
Oh, Mindy, you got to unmute. Sorry, I accidentally muted you. Go ahead.
Okay.
Sorry.
So we'll be going over, my portion is charitable giving vehicles, and we are not talking about the actual donation of a vehicle, although I'm sure Federation would be happy to accept your vehicle, but more different options for ways to give charitably. It's lagging. There we go. Before we get into the nuts and bolts, it might be helpful to just kind of review the why people give. Obviously, first and foremost, to help an organization and You have to have that philanthropic intent in order to be motivated to do any of these. And clearly, if you're on this call, you probably do. So, but also it's a great way to teach your values by giving your valuables, not just to the next generation, but also to charity. So that's important as well to consider as you're doing this planning. Creating a legacy is not only for the family and teaching them about that philanthropic giving, but also creating a legacy at these various charitable organizations that you care about. So, you know, planning through Federation and the other charities of your choice, you can leave gifts that will have a lasting legacy well beyond your lifetime. Certain charitable giving vehicles can also provide an income stream to you during your lifetime, or perhaps to family members in the future. So we'll talk about some of those. And then some charitable giving can be great ways to defer income taxes or eliminate taxes altogether, both on the income side and then also on the estate tax side. So Federation already has accessible to you on their website. Here's the link right here, the jewishnashville.org, ways to give, and then foundation. And these are different pages on a downloadable form. This right here on the left-hand side with the cute little baby is on page 4. And the left-hand column of that page, it talks about charitable giving funds. Those funds are best to be discussed with Shannon and the team at Federation, because there's different levels, and they're obviously very well versed in the different options. Some of those are things that you plan for and fund today, but they're for the future. Some of them pay out now, and some of them are testamentary, you know, not until you pass away and until they get funded. So she can discuss that more with you. And then on the right-hand column are different, you know, options in terms of the vehicles. So that's really where we're going to drill down to today. But conceptually, kind of it's best to think about just 3 different things: whether you want to give a gift today or in the future, whether you want to do a lump sum to the charity at whatever time, or if you want to give a little at a time, like kind of an endowed gift, and then the third option is whether you want to give a specific dollar amount, a specific bequest to, you know, the various charity. And I'm going to use Federation as the charity in this, you know, for these different examples. So do I want to give 100,000 to Federation and let them do with it what they want? So just a lump sum. Or do I want to give 10% of my total net worth and do with what they want, or let that be just they get 10%, but then they only get to make use of 5% of that once I'm gone. So there's lots of different permutations, and but those conceptually are the 3 big things to think about: just the timing of your gift, you know, how much you want to give at once, and then the percentage versus dollar amount. So just drilling down onto that page 24 of the document on the website, you can see on the green column here talks about the different types of gifts. And, you know, the simplest to do, it's just cash and just, you know, have it be a bequest in your will or your revocable trust. But that's not necessarily always the most tax advantageous. If you do have an estate, a taxable estate, then you would get a charitable deduction, your estate would, so that's a benefit, but you don't get income tax benefits from that. Another option, and again, Mike's going to talk a little bit more about this one, is life insurance. So I'll just highlight it here that depending on how it's structured, you can get charitable deductions for the premiums. And I like the way they put this, that it makes, you can make a much larger gift than what you thought would have otherwise been possible, you know, once you're gone. in terms of the death benefit. So that's one that you would do through a bequest, and then there's some structuring elements too. Another bequest option, through a designated beneficiary bequest is through your IRA or 401k, 403b, 457, anyway, your retirement accounts. And this is what I have personally in terms of my legacy planning. I have changed one of my IRAs so that the beneficiaries are charities. My husband had to sign off to say that he acknowledged, because otherwise he had rights, especially in community property states, which we're not. But he still had to sign off acknowledging. But what's nice about it is that the charity will get 100% of the benefit. So if there's $100,000 in there and it's being left to Federation, they will get $100,000 when I pass away. If I were to leave that to my spouse, he would only get, and let's say he's in the top tax bracket, so that's pretty much 40%, close to 40% that would be taken off the top in terms of when he has to take those distributions. He still would have to pay the income tax. And so it is not as beneficial for him to be the beneficiary. And so we'll give an example on the next slide, but it is tax efficient to use an IRA. The next example is a charitable remainder trust, a CRT. And this, as it says, as it sounds like, it's a charitable trust where the charity gets the remainder interest. So before the charity gets their portion, the beneficiary or beneficiaries, more than one, they will get an income stream. And there's different ways that can be calculated, and there's some different things that have to occur. But it's very tax advantageous in terms of avoiding or deferring capital gains taxes. And it allows for an income stream during your lifetime. So we'll talk about that one a little bit more as well, but it's even a nice one to pair with an IRA and have it be the beneficiary of an IRA to extend those distributions. Then there's also a charitable lead trust, and instead of, it's kind of the reverse of the charitable remainder trust. The charitable lead trust starts by giving distributions to the charity for a set period of time, 10 or 20 years, and then the beneficiaries get the rest of it at the end of that period. So, if you have a 10-year lead trust, that you would leave the money, you would fund it into the trust either during your lifetime or at your death. You wouldn't have to pay estate taxes on it. And then it would leave the funds after that 10-year period of paying out to Federation, would leave it to your children or grandchildren, for instance. And then the last one is a life estate reserved. And that one is not one that we've used a lot of, but you can basically get a tax deduction while you're living by giving away your house now and still having use of it. But so it's just reserved for the charity, but it is there for them in the future, and it is irrevocable. So those are kind of, big picture wise, some of the different options. And we really focus in on the first four here with a lot of our planning for clients. So what's the best vehicle for you? Well, it, like everything, depends on your certain, circumstances. So we'll go over some examples. The first one is Sarah. She has 2 kids. Sarah owns a house, an investment account, life insurance, and an IRA. She wants to leave 20% of her total net worth to charity and have the remainder go evenly to her children. She could just say, in her will, I leave 20% of everything and have it calculated out that way. But depending on the size of her IRA, that, as we already discussed a little bit, that really is the best vehicle in this example to give to charity. So if she can designate in her IRA beneficiary bequest form that that be left to Federation or synagogue or whatever, that amount, and the calculations, you know, obviously IRAs are invested, you might be making distributions out of them. And so it may not be exactly 20%, you know, so you can also have a makeup calculation in your will or revocable trust that says, if my IRA does not equal 20% of my total net worth, then I want the remainder to come from my trust or my will, from my estate, essentially. So that's one example. Then we have Rachel, and she has a taxable estate. And right now, you know, that's pretty significant. That's over 11 million for someone with a taxable estate. But there are lots of discussions, and we had a session on it. Our last PAC seminar was on this exact topic, that there's potential for some tax law changes, both on the income tax side and estate tax side, that could change the current exemption amounts or current tax rates. So, so with all these situations, what is appropriate for today may change in the future. So not only does it depend, but it can also change. But for now, with her taxable estate, so she's got, let's say, 13 million, and then her father, Mort, who's one of Ralph's friends, Mort wanted to leave assets evenly to Rachel and her sister. Should have been Hannah and her sisters, but we said Rachel. But Rachel wants to give her portion to charity. So, so this is a perfect example of doing some multi-generational planning. So Rachel could disclaim her portion and leave it to charity, but she would need Mort to be involved in that process while he's still living. Mort would have to change his estate plan so that the disclaimer would flow to basically, if Rachel were no longer living, is how you would think of that, where would her assets flow? And so Mort would have to change his will or trust to make sure that it flows the way she wants. If for some reason Mort's not in a place where he's willing or able to make those changes, and Rachel inherits assets that she doesn't necessarily need, she could always offset it by doing her own donation with other assets that she owns. Maybe some low basis stock that she has would even be a better option. But having that disclaimer language in there at least gives some additional flexibility. Another example are Sam and Ruth, and they have some low basis stock, and they're concerned about future capital gains rates increasing, which is, you know, what we just talked about. You know, there's potential for that happening, you know, with all the infrastructure, you know, potential that is going into, you know, expenses that we're going to be paying out as a government. It needs to be offset somehow. So a lot of people think it will be through increases in our tax rates, and it could be that the capital gains rate actually doubles, is one of the thoughts. And so if that were to happen, some people want to take some low basis stocks, or maybe it's a piece of real estate that they're looking to sell, and they want to convert it, and they want to go ahead and capture those gains. But on the one hand, but on the other hand, they don't want to have to pay the tax. So they like the idea of having a future income stream. And so for them, the idea of donating that piece of property into a charitable remainder trust, or gifting low basis stock into a charitable gift annuity, is a way that it can then be sold with no capital gains tax realized to the donor at that moment. And then the donor will receive, or the beneficiary, usually they're the same person, or maybe there's a different beneficiary, but they'll receive an income stream for their, you know, lifetime, or for a certain period of time. So, so that's a little bit more complex conceptually, but the idea is, if you like the idea of of getting $10,000 a year, rain or shine, and you know that that money was going to go to charity anyway, looking at one of these might be a good option. So then we have our final example, and that's Joseph. And Joseph is in a high tax bracket this year, but he's likely not to be in that same high bracket in the future. So for him, it might be worth creating a donor advised fund, or a family foundation, or an endowment fund at the Federation. So in that example, he would get a full tax deduction the year that he funds the fund, whether it's a donor advised fund or an endowment fund. And so that will help offset that high income earning year. So you would do it in the same tax year as you know you're going to be a high income earner. But those that fund can either be for your lifetime or even carry on, you know, through the endowment fund can carry on for, you know, after lifetime, and honoring, you know, how you want to support charities once you're gone. So I'm going to stop here. It was a lot in a short amount of time, and we will have time for questions at the end. But I will pass it along now to Mike, and then we can go over the questions after that. So let's see. Shannon, can you, I got stopped. Screen share, and I will mute myself.
Yeah, and Mike, you can go ahead and share your screen.
There we go. Can everybody see the screen? Not all assets are created equal.
Yeah.
Wonderful. All right. Well, hi, everybody. My name is Mike Levine with the Levine Group, and we're going to be talking today about some life insurance. So what is life insurance? I found this definition in a periodical, and I thought it was great. A life insurance policy is just a time-yellowed piece of paper with columns of figures and legal phrases until it is baptized with a widow's tears. Then it is a modern miracle in Aladdin's lamp. It is food, clothing, shelter, education, peace of mind, comfort, and an undying love and affection. It is the most sincere love letter ever written. And I just thought that was a wonderful description of life insurance. As Mindy said, life insurance is something that you can gift, and it's a lot larger gift than what you're actually paying in premiums. There are several ways to donate life insurance. One is name the charity as beneficiary. Two, the charity can be the owner and beneficiary. Three, you can gift an existing policy. We're going to talk about the efficiency, as Mindy talked about it, between life insurance and an IRA. And we're also going to talk about using required minimum distributions as premiums. And then also I'll touch a little bit on the charitable remainder trust as also. So you can name the charity beneficiary of an existing policy. This is very easy. So you can literally request a change of beneficiary form. You can make the charity 100% beneficiary, or you can make the charity 50%. You can name a percentage, or you can also name them as a contingent beneficiary. So if you and your spouse were to both pass away, you can name the charity as the beneficiary at that point. It is flexible. You can change it later. Because of that, the premiums that you pay into the life insurance are not tax deductible. So if tax deductibility is important to you, then there's a couple of things you can do. Number one, you can take out a new policy. The charity can be the owner and the beneficiary. So when you do this, the premiums paid are going to be in the form of a donation to the charity, and then the charity would pay that premium. The charity is also the beneficiary on this policy, and thus it is a tax deduction. You can also gift an existing policy. So let's say you took out a policy back when your kids were young, and your kids are now older and you don't necessarily need the insurance. Your assets have grown. So one thing you can do is to donate your policy. You can gift that policy to charity, It is partially tax deductible. There is a formula the insurance company uses, and the insurance company would tell you how much of a tax deduction you would get. Similar to the last slide, future premiums are paid via the donation to the charity, and thus the future premiums are tax deductible. But it is irrevocable. So once you gift this policy and you take that tax deduction, it is irrevocable. It's not going to come back. So let's talk a little bit about life insurance versus an IRA. Mindy touched on this. And so which is better to leave the children, life insurance or an IRA? Well, here an example, if somebody had accumulated $1 million IRA and they've got $1 million life insurance policy, with the new law that started in 1/1/2020, IRAs now have to be taken out over a 10-year period when it's passed on to the next generation. You can pass it on to your spouse without, it can be a spousal IRA, but when the next generation takes it over, that has to be taken out over 10 years. So what I did here is a very simple calculation of if you were to take that IRA and you were to invest it at 5%, and you were in a 25% tax bracket, and you took 1/10 in the first year, and then you took 1/9 in the second year, and 1/8 in the third year. So thus you're taking that money out equally over 10 years, and you're paying 25% taxes on that. At the end of the 10 years, that IRA to the children is $990,000. If you left the IRA to the charity, and then the life insurance went to the children, and you got the same 5% growth and 25% taxes on the growth, your kids at the end of the 10 years would have almost $1.6 million. So in this case, everybody wins. The charity wins, your children come out better. It's a win-win. Let's talk a little about required minimum distributions. So required minimum distributions now are required to start at age 72. Many of my clients do not take more than that. A lot of them take just the minimum. A lot of them do not need the money, but since they're required to take that money, what are they going to do with it? Well, some of the clients actually decide to buy life insurance premiums. If you buy a life insurance policy, those premiums, again, explosion of value upon your death. You get a lot more bang for your buck. And even better, you can use what's called the qualified charitable donation to donate to the charity and let them pay the premiums. This could potentially lower your tax burden by giving it directly from your IRA to the charity. Now, you want to make sure you talk to your accountant and your tax attorney. We have several here on the call to make sure that you're doing this correctly. But so how much would $20,000 a year buy? So if you're in good health and you're age 70, a woman would be able to buy approximately $800,000 of insurance. And a man, because we don't live as long, would only be about $700,000 of life insurance. But as you can see, that's a lot more money left to the charity with the use of life insurance. And finally, let's talk about charitable remainder trusts. Mindy talked about this for a little bit. There's a lot of different ways to do it. We're going to make this just simple. So if you are, as the donor, were to gift a low basis stock, so you bought Amazon back when it was $12 a share back to 20 years ago, and now it's worth $100,000 or probably more than that. So you can avoid having to pay the capital gains tax. You would receive payments during your lifetime, and then anything left out of that bucket would go to the charity. And this is the way that it is a charitable deduction today while you're in a higher tax bracket. But what about the children? You gave that money to charity and nothing to the children. So when you give that money to the charity, when you're taking your ongoing income, the idea is that you can use part of that money to pay life insurance premiums. if you were to set up what's called an irrevocable life insurance trust, or an ILIT for short, then those premiums are made to the ILIT. The ILIT pays the insurance company. Upon your death, the life insurance policy gets paid back to the trust for the benefit of the children. So here is a win-win. You get a tax deduction now, you get income for the rest of your life, and the kids get all that money estate tax-free and income tax-free. So win, win, win. And with that, I thank you very much. And I will stop sharing and let you take it over, Shannon.
Great. Thanks both to Mindy and Mike for your presentations today. And Mindy and Mike will be joining two panelists that we'll be using for our Q&A. Eva Pulley is a senior manager in the Tax Services Department of Kraft CPAs. She has 33 years of public accounting experience and specializes in estate and trust planning, taxation, and administration. She oversees the accounting and tax services for several corporations, partnerships, estates, and trusts, as well as individuals. Ralph Levy is our other panelist. He is a senior attorney in the healthcare practice at Dickinson Wright. He assists and advises entrepreneurs and owners of closely held businesses in operationalizing their business plans, including estate planning, business succession, and tax planning issues. And his areas of practice include corporate governance, emerging businesses, estate planning and administration, healthcare fraud and abuse, healthcare providers and suppliers, mergers and acquisitions, taxation, and tax controversy. So we are coming to the Q&A portion. I've gotten some questions so far, but if you would like to share or do verbal questions, you can share via the chat. You can send me a private message if you would like to remain anonymous with your question, or you can share to everyone in the chat. And again, you'll have an opportunity if you'd like and prefer to ask your questions verbally. So just give me 1 minute to get myself set up for the Q&A. Okay. So one question we have, for the panelists or presenters, my IRA would pass to my daughter upon my death. I assume the increase in value could be taxable. If I leave 10% of my IRA to Life and Legacy, I guess, to one of the charities, is that taxable as well?
The portion left to the charity would not be taxable. Anything from an IRA that will benefit an individual will be taxable, regardless of the basis, or excuse me, I don't want to say the word basis. That's a different aspect. The increase in value in your IRA will be taxed. Every dollar that comes out of the IRA will be taxed unless you do have a basis in the IRA, which is a non-deductible item throughout your lifetime. So the majority of the IRAs that are dispersed are fully taxable, but occasionally there will be a non-taxable component. So each situation is different. But the portion that does go to the charity would not be taxable at all, but everything going to the daughter would be taxable.
Eva, one exception to that would be with respect to a Roth IRA, where the money that is pulled out, only the appreciation will be taxed.
That's correct. The Roth IRAs are different than your traditionals.
Yeah, and I would just add, that's a great point on the Roth, and meant to highlight that in terms of, if you have a regular IRA and a Roth IRA, use your regular one to leave it to charity, and let that Roth go to your children, because it has essentially already been taxed, is the best way to look at that one.
And the gains on the Roth are also tax-free.
Correct.
And the other part is, in this example, the question was about leaving 10% to charity. And even in my example, we spoke about percentages. I just learned today of a company, an investment firm, that their designation forms don't allow for percentages. It has to be for charity. It has to be dollar amount. So we're kind of talking broad strokes, but once you get into the details, sometimes you have to change your patterns a little bit based on what a specific organization's rules are. So just keep that in mind.
We have another question about the charitable remainder trust, and I think it's just wanting a little bit more information. The gist that I understand from the question is, there was sort of a formula of how you get paid and then how the charity receives the benefit at the end. And I think they're wondering how those payment works. Do you get a percentage? Is there a formula that you get paid each year? That type of thing.
Go ahead, Mindy.
Well, Eva or Ralph are probably equally, if not more, able to answer this, but I can start. And so yes, it's based on some actuarial tables. And so it's based on the donor and beneficiaries' ages, and we'll just say they're the same, but and then also whether it's a lifetime or if it's just for a set period of time distribution to the beneficiaries. We have some that are structured that based on the donor/beneficiary being older than, I think at the time they were around age 70. It's a 10% payout to them during their lifetime, and it's husband and wife, and they both get to benefit from it. And so until the second passes away, they're receiving a 10% of whatever the annual income, whatever the annual market value is. So on 12/31, if the value is $1 million, then they're going to get 10% of that, $100,000 in the following year, distributed quarterly, so $25,000 a quarter. That again fluctuates. That's a charitable remainder annuity trust, and unitrust. So CRUT, there's also an annuity trust, which is a CRAT, which has a little bit different formula. But that continues for their lifetime, and then at the end of that second to death, then it goes to the charity, what's remaining. And Eva or Ralph, if you want to add anything to that.
Yes, the one of the things to watch for that I've noticed is the language in the document itself, because occasionally we will have a distribution requirement, but if the income is not earned in the trust up to that point, we're limited on how much can go back out to the beneficiary. So usually I think there is a minimum of 5% payout. You can't say I want a 1% payout. So if it only earns 3%, then we're limited to only giving you the 3%, even though the document says 5%. But if there's flexibility in there to allow for the capital gains to be considered income for purposes of distributions, then we can get that full 5 out. So we've had some that have had to be, I'll say not to court, but a non-judicial agreement, so the charity consents to the wording of the intent that the donor had. So because the beneficiaries were not getting the benefit of the payout when the market declined and the earnings weren't there. So the wording there is very important. But if the market is high enough and the income is high enough, it's usually not a concern. You're going to get that portion out. So there's different complexities in that document that would make sure that we're going to get that payout out to them.
Yeah,
and the charity gets the balance.
As Mindy alluded to, the other option would be for the individual who sets up the trust to say, I don't care whether the property appreciates or depreciates. I want to get X thousand dollars per year or per month or whatever it is. Mm-hmm. So that's a different type of trust, and the actuarial value for the charitable donation would be computed differently using different type of tables. That's one point. The other point is because of the complexity of two other points. The second point would be you could also have the income retained for more than one generation. So the income could go to you and then to your children and then goes to the charity. The problem is the IRS says that the actuarial value of the charitable interest has to be at least, I think, 5% in order to get a charitable deduction of any type. The more successive
10%.
I'm sorry, 10%. Okay, thank you, Mindy. 10%. The higher the lower the payout, the higher the actuarial tables would indicate it goes to charity, which means your deduction goes up. And the other and final point, this is a practical point, you really, in order to get into some of these details on a charitable remainder trust or charitable annuity trust, you need to really be thinking about a fairly significant donation, at least $50,000, $100,000, somewhere in that range, to make it just worth the cost, because the paperwork cost, whether it's a $100,000 gift or $1 million gift, at least from my standpoint, is the same.
Well, and as you said, the cost involved, we have annual filings that are required for the tax returns. So you don't want it to be cost prohibitive for paying professional fees to maintain a trust that is of a small value.
And that's why a gift annuity is another option that you don't have as much control over, but conceptually is very similar in terms of getting income to beneficiaries for a certain period of time, and then usually their lifetime, and then the balance going to the charity.
Mm-hmm. All right. So I have, I guess people are interested in trust today. So they're wondering, they saw the charitable lead trust and the charitable remainder trust. And this person is wondering, when would you want to get a charitable lead trust versus a charitable remainder trust?
Well, the lead trust, you are giving up that income right. So that's the main difference. The remainder trust, the charity does not get a dime until the end of the term or the death of the person that was the last beneficiary. So the charity doesn't get the benefit immediately. The charitable lead trust, the charity gets the immediate benefit. They get the income during that same time period. Either they get it for a term or until the designated beneficiary, it's to, or a certain event triggers that to stop. So if you do not need the income to live on, but you do want your family or children to inherit it, the pot at the end, the charitable lead trust is maybe favorable. I see more charitable remainder trust than I do charitable lead trust. I mean, we have both, obviously, but they're heavier on the unit trust, mainly because that income is still being there for a lifetime.
So one example would be a high income taxpayer is convinced by a friend of theirs to make an investment in some unimproved real estate, and that real estate dramatically increases in value. For example, some real estate that's unimproved in Nashville, and then there's going to be a sales event, and that individual is concerned about the income tax cost to the individual because they're already in a high income tax bracket. And they were concerned also about any potential capital gains changes. So that person may want to say, well, once I retire, because for example, I provide professional services such as physician, accountant to a lesser extent, or even an attorney, I want the income. I'm going to set up a charitable lead trust so I get an income tax deduction today to offset some of that income tax cost from the sale, and also to offset my other income. But I only and then the charity is going to receive the income off of that asset once it's sold for, let's just say, 10 or 15 years until I retire, because my income is going to go way down once I retire, and therefore I need the income. So that's an example of a charitable lead trust, and I've only drafted less than a handful in the time I've been practicing law.
Yeah, I'd reiterate that as well, that we see a lot more charitable remainder trusts than we do charitable lead trusts. But, we have had clients, where the father has left for the children in his will, part of his will, so it was just one part of a larger plan, the charitable aspect was put into, a certain portion of his estate was put into a charitable lead trust. It paid out actually to Federation, and they had, each child had a donor advised fund at Federation. And so then they were able to distribute it how they wanted to. And then after 10 years, that went into another, went to the children essentially. And that helped in terms of dealing with what was a taxable estate. So, so that, another way that a charitable remainder trust can be used with another plan is with to have a charitable remainder trust be the beneficiary of an IRA. So Mike talked about using, an IRA to, during lifetime for those premium payments for life insurance, but this is a different way to use an IRA in conjunction with something else. And so you can have an IRA now, once it distributes to the next generation, will have to be paid out, as Mike mentioned, in a 10-year period. That might put people at a higher tax bracket. If you leave it to if you let your beneficiary of your IRA be a charitable remainder trust, it won't get funded until you're gone, but it will be able to distribute to the next generation over, let's say, a 20-year period, maybe based on like a 10% payout as an example, depending on their ages. And then they will get that income stream, and at the end of that period, then it will go to charity. That essentially helps stretch that IRA over a longer period of time versus the forced 10-year payout of a normal IRA right now.
Okay. Thank you, guys. I have another question. It was concerning the ILIT. I think there was some interest on, the life insurance trust, how that works. I think they just wanted, it was a great explanation, but I think, and Mike, if you want to just kind of go through it one more time, because they were just like, it was a little bit fast. It sounded interesting. I think they just want a little bit more explanation about it.
Sure. So an irrevocable life insurance trust used to be used a lot more 20 years ago when the exemption was much lower. Today, if you leave $1 million life insurance to your family and your assets are less than, you and your wife, less than $23 million, that money goes income tax free and estate tax free to your beneficiaries. However, if the administration lowers the exemption much lower, it's going to put a lot of people in a taxable estate. One way to make sure that the life insurance is outside of your estate, this is the key, is by setting up an irrevocable life insurance trust. So the trust is the owner and the beneficiary of the life insurance. And when you pass away, that money, that life insurance funds that trust for the beneficiary of your children. So then the children can receive income from that trust, and that trust is outside of your estate. Thus, the life insurance proceeds are non-estate taxable.
Okay. Just a couple more questions. And again, participants, I'm going to go through the last couple questions I have, but if you do have any, we do have time for a few more if you'd like to send anything to the chat. All assets are created equal is the title of the workshop or our seminar. So if they are created equal, I guess they're just wondering, what is sort of the most important thing to consider, when you're looking at the different options?
I would say talk to your professional.
Yeah, Shannon, one of the topic that we talked about was the charities don't have to pay income tax. So therefore, if you have charitable intent, it's a lot more cost effective to give the IRA or designate the IRA to charity as opposed to giving the charity the life insurance, where the proceeds of a life insurance policy are non-taxable. The similar analogy where you don't have a charity involved would be where a parent has two different children, one of whom is a high income earner and one of whom is not. You might want to give the IRA to the lower income earner, because the income tax rate is going to be, an income tax bite on that asset's going to be a lot lower than if you give that asset as an IRA to the high income earner. So that's how we kind of came up with the title, that because the IRA carries with it an inherent tax burden, the value to the recipient is not quite as high as an asset that where it's previously been taxed or is non-taxable, such as life insurance policy.
And just to add to that, we hope no one is dealing with this, but if you're ever going through a divorce, it's the same idea. You need to be careful about what assets are being divided in which way based on tax implications. Similar idea.
Mm-hmm.
Right. Are there any, before I start wrapping things up, I just wanted to give a chance for anyone if they want to jump in with a question.
While people are thinking, I did forget a couple of little pieces, and just the idea of, your beneficiary designation bequest through IRA and life insurance was kind of discussed. The idea being that it's a lot easier to make those changes than it is to change, your will or your revocable trust. So sometimes that's also attractive, even despite the income tax piece of it. It's just a lot quicker to make those changes. And then the last thing is, for whether you do a donor advised fund or however you donate low basis assets, I forgot to mention that it really needs to be assets that you've held for more than a year, because you don't get the same tax benefit if it's short-term assets. So if you made a bunch of money in GameStop, that's not the asset to donate to charity in any of these different vehicles.
Great. Thank you. Thank you, Mindy and Mike, for presenting, as well as Eva Poli and Ralph Levy for participating on our panel. I want to thank the Jewish Federation of Nashville and the Joe Kraft Professional Advisory Program Fund and the Harris A. and Diane Gilbert Area of Interest Fund for Education for supporting today's program. Thank you for joining us. We hope that we've given you some valuable information that will assist you in getting started or continuing your financial and estate planning journey, as well as empowering you to fulfill your philanthropic passion and commitment of leaving a lasting gift to the Nashville Jewish community. If you're interested in signing up for future seminars, you'll get a link through email. Also, I will be emailing out the video on today's presentations if you want to share with anyone. And also the link to our website that Mindy referenced today, as well as the presentation PowerPoint. You can also have that as well. And again, once the link is up for the 4th seminar, I'll be sure to send that out. And there'll also be information posted, in our electronic newsletter. Thank you again, everyone, for attending our 3rd seminar, and have a wonderful rest